of winning spirit. People are like, we are very good at motivating everybody else. When it comes to us, we don't. And then lack of focus. A lot of people not even able to watch an Instagram status or Instagram reel for 60 seconds. And then we introduce a philosophy called self-improvement. It actually helps families to grow their thinking, which eventually brings peace in their family. Now, we call it a new art of living because this new art of living actually changing many families' life. So I will just get into detail on this particular subject a little bit, like how and why we should have this conversation. Okay, they are not happy with their savings, So if you can actually go to ChatGPT or anywhere, you can just do the search, the biggest regret of Canadians. So they will say they did not save enough. So that will be their the biggest regret. So the process of wealth creation, whenever we talk to families, we say like this. So most people make their paycheck and then they bring the money to the family. Some people makes $100,000, $200,000, etc., etc. So the money goes through their bank account most of the time. So they are not really able to save much money out here. So most people are not able to save even 10% paycheck out of it. So we say once you save 10%, we help them to understand, apply these rules of money. The first one is compounding effect, means their money must grow. The second one is risk effect, means their money must be protected. Third one is tax effect, that you will be paying the lowest possible taxes. Now, the third one is we help families to accomplish the goals like income protection, income replacement, and generational wealth. Because income is our most important asset, this must be protected. And income is, at some point you will have to stop working. At that time, you need to make sure where the income is going to come from. And a generational wealth. So this is something that you need to make sure what are you actually giving into the next generation as well. So we make sure that you have a saving discipline. You empower 10% savings, you plan a secured future. So these are the three main areas that we help families when it comes to saving and growing money. So the another major challenges in the community that we face is rising debt. So you see, insolvent millennials, an average age is 33-year-old, and then they have about $47,000 unsecured debt. So this is not something we are talking about some neighbor story. This is our own backyard story that we are talking about it. So rising debt is the biggest issue. And you see 3 in 10 adults frequently worry about their debt. So, like you can see 16 of them every day, they're at the amount of debt they have and being able to save enough for their retirement or paying their bills, the cost of healthcare, paying the rent on the mortgage, being able to buy their food, losing their job, taking a pay cut due to reduced hours. So these are some of the actual statistics the people are actually worrying about their debt. The another thing here is that the biggest debt the most Canadian have is their mortgage debt. Now we have a product called a Manulife One Bank Mortgage Strategy, provide a custom mortgage solutions to help meet their client goals. So example, if a client has $1 million home value, their mortgage balance is $500,000 and their interest rate is 3.5%, 5-year term, 25 years amortization, and they're making $2,500 monthly payment. And their check-in expenses is check-in account $500, savings are $10,000, household income is $8,000. So household expenses $4,000. So these scenarios, we can actually, if you have a Manulife One Bank, you can actually save about $58,000 in interest cost, and you can be debt free in 14 years, 2 months earlier. So you can unlock about $315,000 home equity in your own borrowing room. So if your current mortgage is, they're supposed to pay about $248,000, and then they will be technically, based on the exact scenario, they will be debt free in 25 years. So with the Manulife One Bank, including all the other debt, they can actually pay earlier than 14 years, 2 months. They can just pay off their debt faster. So there is multiple solutions we can talk about when it comes to debt. Now another way that we can talk about children financial planning. Many people like immigrants especially, they're worried about their kids' future planning, right? Now, here, if you see, the rising tuition and student debt is heavily on post-secondary students. Now, one of the largest university dropout country in the world, it's Canada. Why? Because the Canadian education cost is very high. Due to that, the students, the kids needs to go to part-time jobs while they're preparing for their studies. So at that time, they cannot handle the pressure of student loan, their studies, and the part-time job. So eventually, a large number of students, they drop out university and they pursue their part-time jobs as a career. So in order to avoid that, government is supporting a lot of grants and scholarships and all those things are providing it, but many people are not able to take advantage of that. Now, I'll just give you an example of a parent who is actually helping their child with savings. So this parent actually put together income plan and education plan while using their child benefit. So a newborn, if they contribute $350 per month, so at $250, they contribute towards an income protection plan, and then another $100 they contribute towards an RESP. So let's look at the scenario here. So this baby Amir, they contribute towards this whole life plan. So where they contribute about $3,000 annually for 20 years. So they technically pay off this plan in 20 years. So after 20 years, they can actually start growing, withdraw about $5,000 per year for education every single year. And if they want it at the age of 30, they can also withdraw about $30,000 for their first time home buyer down payment. And they can take about $18,000 per year for their retirement for till age 85, from 65 to 85 every single year. So this is like a paid off asset that you're actually giving it to your kids, by just putting together the $350 savings, right? Now, there's another $100 goes towards RESP. So by the time the Amir is ready to go to the university, he has about $51,000 sitting inside the RESP as well, based on a 7% rate of return. I'll show you more details on this, how this rate of return actually can change your future. So the total contribution it's only $21,100, and the government is contributed about $5,000 grant. The total education utilization fund is sitting at about $51,848, and that can be utilized for educations at the age of 18th birthday. Now, total wealth created here, usable at age 18, it's about $115,000 by contributing about $60,000. Usable at age 65, it's about $723,000. And total generational wealth at age 65, it's $1 million. So by contributing that $250 for a newborn from their parents, right? Now, saved by their parents for whole life and RESP, it's about $81,000, $100. That is the whole total contribution the parents actually put it forward for this scenario. So now let's say a family who decide to put a financial planning. So let's say they decide to save 10% and they want to follow these rules of money and goals. Now this is how their family situations looks like. So impact of losing an income. Many people don't really think about losing an income, how it is going to impact their family. So losing wealth, health and life, how financial loss can impact their family's life, right? So Canadians now expect to need about $1.7 million to retire, according to this RBC survey. Now, most of the immigrants are like a sandwich generation, right? You have to look after your parents, you have to look after your kids, and you are basically a retirement package for your parents, but then you have to look after yourself, right? So at some point we have to leave the job, either by choice or force. So we make sure that you need to have enough savings in place for your retirement as well. Now I'll give you an example. This family, the Smith family, who makes about $5,000 monthly income and already on their first home, age 27. So they take out 10% of their monthly savings. So if they're making $5,000, we say, okay, save $500 a month. So how it can impact their future. So Mr. Smith contributes about $280 and Mrs. Smith contribute about $220. They opened a combination of universal life and tax-free savings account, universal life and tax-free savings account. Every month they decide to contribute for next 10 or 20 years. So we will see how it is going to impact their family, right? So let's say what this Mr. Smith did. So he used $200 towards a fixed solution. So then they contributed about universal life and whole and a term plan, which protect their income first. So they have about $1 million life insurance in place, and they have their income replacement is about $55,000. Their cash value is sitting at about 20 after 20 years, and their cash value of whatever they have contributed it becomes about $218,000 at the age of 65. Okay. And they have a generational wealth of $350,000 paid off money goes towards their next generation. And then another $80 they decide to contribute towards a tax-free savings account every month. And based on 6% rate of return, after 20 years, they have about $37,000 sitting inside their TFSA. And the value of that TFSA becomes $146,000 at the age of 65. The total wealth created this family at the age of 65 is $364 by saving $280. And same with Mrs. Smith, also the same area. So because she contributed comparatively less. Now in this case, so Mrs. Smith contributed $140 monthly. Now they have universal life and term plan in place by contributing $140. So this becomes about $850 income protection. And they have about close to $40,000 after 20 years and $152,000 at the age of 65. And then paid off lifetime benefits about $350,000. And Mrs. Smith also contributed $80,000 towards TFSA. And based on 6% rate of return, they contributed that FHSA account, and then they build pretty much exactly similar savings. So in this family, by contributing $500, this young family have usable savings about $663,000, and their generational wealth they have created about $700,000 at the age of 65. Now the total wealth at the age of 65 is $1.3 million that they have created by contributing $500 for their own retirement, for their own savings, for their own income protection, income replacement, and generational wealth in this scenario. Now, like we work with all type of scenarios, like I just discussed about, when it comes to debt, when it comes to children education, when it comes to financial planning of a family. Now I'm just going to touch bases about business planning, business financial planning as well. So, partnership, economic conditions, debt, loans, interest rate, multi-generationals, estate equalization. So these are the main areas most of the businesses struggle out there. So like if you take your personal dollar, like whether it is your employment or whether it is your corporation, you get taxed about approximately 50%. And so then technically you get 50 cents out of it. So if a business owner decides to take a personal dollar. So what generally they do, they buy assets, insurance, or investments using that personal dollar. Now a corporate dollar, it's only 12% taxes. So this is where many people open self-employment or a business, because they realize the corporate dollar taxes are comparatively much less if you compare to a personal tax dollar. So because if you do a job, most of your money goes in taxes, but if you're corporate dollars, it's only like 12% taxes in Canada. So the corporation owner can actually utilize 88 cents for their further investments, versus an employee are able to utilize only 50 cents per dollar. Now they can use this 88 cents per dollars, can buy assets, insurances, or investments can be utilized. Now, so the questions to ask, most business owners don't really understand what is CDA, Now, what is the size of their current CDA? What grows the size of the CDA? So most of the time, this is the only thing that you take out after you're running years of businesses or years of hard work. So this is the most important question that you need to ask your accountant or your CPA. How much is the size of my CDA right now, and how much I can grow the CDA, because the CDA is the only thing that you're peacefully taking out from your business for your future. So CDA means it's a capital dividend account. It's like a hidden wallet of a tax-free money inside a corporation. So CDA turns a corporate wealth to a family tax-free money out there. So CDA is the strategy to look after most businesses' needs. So find out what strategy can help you to grow the size of your CDA.